Hey everyone, welcome back to Corporate Decoder. Today, A.C.P. Holdings Acquisition Corp. Ticker ACCU just filed its Form 8K, and we are seeing a shift towards independent trading of its shares and warrants, plus a small but interesting detail about founder shares. Quick note, this is not financial advice, just my take on public filings for educational purposes. The big news here is about how investors can now trade parts of their investments separately, which could change how the stock moves. Alright, so what is happening with A.C.P. Holdings Acquisition Corp, or ACGCU as it is known on the market? This type of filing, an 8K, is like a special report that companies have to send to the US Securities and Exchange Commission, or SEC, whenever something big or important happens that shareholders should know about right away. Think of it as a news alert from the company itself. Let's look at what is actually registered with the ACGCU has units, which are like a package deal. Each unit used to be made up of one Class A ordinary share and half of a redeemable warrant. These units trade under the ticker ACCU on the Nasdaq. Then you have the Class A ordinary shares themselves, trading as ACC, and finally, the warrants, which give you the right to buy shares at a certain price, trading as ACGCW. The exercise price for these warrants is $11.5 per S-share. This structure is pretty common for special purpose acquisition companies, or SPACs, which are essentially companies formed to buy or merge with another company. So the main event here is that starting around May 28, 2026, investors who hold these ACGC units will have the option to break them apart. They can choose to trade their Class A ordinary shares, which is the ownership stake in the company, separately from their warrants, which are more like options to buy shares in the future. Right now, if you buy a unit, you get both. But soon, you'll be able to buy just the share or just the warrant. This is a pretty standard move for SPACs after their initial public offering, or IPO. The units are sold as a bundle to make them more attractive initially. Once the company has completed its IPO and settled into trading, they often allow the separation of these components. This gives investors more flexibility to manage their holdings based on their own investment strategies. For example, someone who believes the stock price will go up might hold onto the shares, while someone who thinks the stock might not move much might sell the warrants to capture their current value. The units, as we mentioned, were initially made up of one Class A ordinary share and one half of a redeemable warrant. Each full warrant essentially lets the holder buy one Class A ordinary share for $11.5. This price is important because it sets a cap on how much value the warrant can unlock. If the class's share price rises significantly above $11.5, the warrants become more valuable. If it stays below $11.5, the warrants might not be exercised. The Class A ordinary shares themselves have a very small par value, just $0.0001 per S-share. This is largely a technicality for accounting purposes and doesn't reflect the actual market value of the shares. The key takeaway is that these are the core ownership stakes in the company, and the warrants, each whole warrant is exercisable for one Class A ordinary share at that $11.5 price. What this means is that if the company's stock price climbs well above $11.5, these warrants could become quite valuable. However, the filing also notes that no fractional warrants will be given out when units are separated, meaning only whole warrants will trade. This is standard practice to simplify trading. Now, let's talk about the founder shares. This is a really interesting detail that sometimes gets overlooked. A.C.P. Holdings Acquisition Corp. had its IPO back in April 2026, selling 20 million units at $10 each, which brought in a cool $200 million. The underwriters, Roth Capital Partners, LLC, also had an option to buy up to an extra 3 million units to cover any unexpected demand, known as the over-allotment option. They did exercise a portion of this option, buying about 1.46 million additional units. The company sponsor, Union Street Sponsor, LLC, had a large block of Class B ordinary shares, which are typically for the founders and early investors. A portion of these shares, up to 1 million, were set to be forfeited depending on how much of that over-allotment option was actually used. Since the rest of the over-allotment option expired unexercised on May 22, 2026, a total of 512,800 of those Class B ordinary shares were forfeited by the sponsor. This means that these shares are effectively cancelled and returned to the company, reducing the total number of shares outstanding held by insiders. While this might seem small compared to the total shares, it is a signal of the underwriters not needing to exercise their full option to stabilize the stock price, which can sometimes be a positive sign that the IPO demand was met reasonably well. It is also a way to keep the float, or the number of shares available for public trading, in check. When founder shares are forfeited, it can sometimes be seen as a sign of commitment from the sponsor to not dilute the public shareholders too much. This Form 8K also lists exhibits. The most important one, Exhibit 99.1, is a press release dated May 22, 2026. This is where the company officially announced these changes to the public, and there is also Exhibit 104, which is the cover page data in a format that computers can easily read. Finally, the signature section shows that the report was signed by Andrew Malozzi, the Chief Executive Officer, on May 22, 2026. This confirms that the company is officially making these announcements. So, looking at this filing, the core story is about increased flexibility for investors in ACGCU by allowing separate trading of shares and warrants. This is a common step for SPACs. The forfeiture of founder shares is a minor but notable event, showing how the structure of the IPO incentives worked out. It doesn't change the fundamental business of the company, which is still focused on finding a merger target, but it does affect the share structure slightly. For investors, this means you'll have a clearer choice. Do you want direct ownership through the shares, or the potential upside from the warrants? With the shares and warrants now trading separately, investors can more precisely bet on the company's future success or manage their risk. The risk I'm watching is how the market reacts to the continued search for a merger target, and if the separate trading of shares and warrants will lead to more price volatility based on investor sentiment towards warrant value versus the core business. What I am actually looking for is news on the actual merger. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Check out the Discord in the description.